Trading is one of the most interesting professions out there. I mean, you've got full flexibility and you've got full control, whether that's your time, whether that's your income, the number of hours you spend researching, charting, actually trading, editing things, marking up your charts. I mean, really, you can do it from anywhere. So you've got all of this, and there's a lot more that comes with that too. But did you know that what you trade could make a potentially very big difference in your income and what you take home at the end of the year? So today we're going to be covering exactly that and the advantages that futures trading has to offer when it comes tax time, and it may have you rethinking what products you're trading. Now, this is not a video that everyone loves to talk about because we're not talking about how to make 1,000,000% gains on this and on this strategy and this indicator and this and that. But this is actually really important because as you get to a point where you are pulling profits out of your trading account, well, you're going to have to pay taxes. And trading different things means you're going to get taxed in different ways, much more detailed than the simple long-term capital gains versus short-term capital gains that many people are semi-aware of. Now, before we dive in, I do want to give a quick shout out to the sponsor of today's video, Jigsaw Trading. Jigsaw Trading offers traders an edge in the markets through powerful and intuitive trading software. With advanced tools for order flow analysis, visualization, execution, and advanced analytics and trade journaling, Jigsaw Trading gives traders a real-time view of market activity and helps them make better informed trading decisions. Whether you're a beginner or an experienced trader, Jigsaw Trading has something to offer from their starter package to their professional package. Plus, their team of expert traders is always available to provide guidance and support. Take your trading to the next level with Jigsaw Trading. 14-day money-back guarantee. Try it today. Thanks for Jigsaw for sponsoring today's video. All right, so let's dive into it. Now, I'm going to be leaving a link to an article from GFF Brokers that explains some of what we're going to be covering in this video if you want like a written resource and some examples. Now, there's an example in there when it comes to one of the pieces of this video that I want to talk about that may be confusing. And so I've got a better example, I think, or at least I'm going to try to explain this better so that you've got something more tangible to take away from this video. Because I know it kind of confused me when I first read that. And I was like, I feel like you could have explained that a little bit better. So that's what we're going to try to do. Okay, so we've got really two traditional ways that people know of taxes, right? You've got when it comes to trading and investing in stocks and all those things. And you know that there's short-term capital gains and then there's long-term capital gains. Now, if you're holding an asset or whatever position you've got for over a year, you'll potentially get taxed at the long-term capital gains. Now, if you will buy and sell, let's say a swing trader or a day trader, well, you probably can assume that you're going to be taxed as a short-term capital gain on that position. And of course, there are losses there. And of course, losses are losses. You're not going to be paying taxes if you're losing money. So don't really worry too much about that. And that's generally the same thing for most asset classes. The thing is, the way we calculate potential losses throughout our trading, even if we're or when we're profitable, that's where there's nuances, and that's what we want to talk about more in this video because it's pretty straightforward. If you're watching this video before you've got tangible trading profits, it's great. It's great to know about these things and it's awesome, but realistically, you need to get to that point first. And so once you're there, knowing what we're going to be talking about is going to be very beneficial. So we talked about the long-term capital gains and the short-term, right? If you hold, let's say you buy Apple stock or, whatever, and you hold Apple stock for 2 years, you sell it, you're going to get taxed at your long-term capital gains tax rate. And of course, here is a look at the long-term capital gains tax brackets. Now, if you buy and sell Apple, let's say bought it Monday, sold it Friday, made 2% because I hold it for earnings or something like that, or maybe 5% because I held it for earnings. Great. I'm going to have to pay short-term capital gains, which is going to be taxed at my income level on my tax bracket, which is going to be different for everyone. But when we get to futures trading, here's what's awesome. It's something called the 60-40 rule. You are not taxed on your capital gains short-term, long-term. You are taxed 60% at the long-term capital gains tax rate, and then the other 40% at the short-term or at your short-term capital gains tax rate. So, for example, let's say you make $10,000 in a given year. $6,000 of those dollars is going to get taxed as if it was long-term capital gains, okay? 4,000 of those dollars is going to get taxed as it was short-term capital gains at your tax bracket range. Light bulb should be kind of dinging off right here. It's pretty big because if you're someone who starts to increase your income substantially over time, or you already are making a lot of money in a job or whatever, a business owner, something like that, well, then once you start, if you're trading futures and you're making a lot more money on top of that, and now you're upping your tax brackets or at the higher end of the tax brackets here, well, now only 40% of your income from futures trading is going to be taxed at your short-term capital gains, and potentially or most likely on a lower tax bracket, you're going to have 60% of your trading profits from futures. That's going to be taxed at the long-term capital gains, which ideally and most likely is going to be lower for most people at higher incomes. The next big piece to futures trading taxes, when it comes tax time, there's something called the wash sale rule. Really not when it comes tax time, but just in general, if you are familiar with trading, swing trading, even investing, you've probably seen on your financial statements from your broker something called wash sale or wash sale disallow. There's a section on there. And this wash sale rule does not apply to futures trading. That's pretty big, and that's a very complicated piece of trading taxes. Now, I will say, for someone who is a day trader, you don't really care too much about the wash sale rule, and you'll get to, and hopefully you understand what I mean here in just 1 second. Now, the wash sale rule is an IRS regulation that essentially prevents a taxpayer, you and me, a trader or whatever, from taking a tax deduction from a loss on a security sold in a wash sale, okay? So essentially the rule is defined by a sale that occurs when an individual sells or trades a security at a loss and within 30 days before or after this sale buys the same or a substantially identical stock or security or acquires a contract or option to do so. So let's say you're someone who buys Apple stock and you buy Apple on a Friday, and then next Friday you go and sell Apple for a loss. Well, technically speaking, you can't just go and say, oh, well, I'm going to take that $1,000 loss and write it off against my taxes and my income, but I'm going to go buy Apple again, and now I'm going to hold Apple for a while. And I'm just going to, reestablish my position at a lower cost basis, lock in the loss, then I'll rebuy it. Well, you technically can't do that if you're looking to take that tax advantage. You'll have to wait the 61 days, so 30 days prior to the day a transaction takes place and then 30 days after to essentially remove yourself from having to deal with the wash sale rule. Now, going back to what I said before, a day trader, who trades, let's say a series of 5 stocks or trades the S&P or, whatever, it doesn't really matter because you're going to be in and out. Like, I don't really care. I'm not locking in a loss to, come tax time. Be like, oh, okay, I'm locking in a loss and I'm going to reestablish my position lower. No. I'm just looking to make money off the fluctuations off of my strategy. Like, I don't really care. But maybe a swing trader or somebody else, this might be a pretty big deal. And let's say, again, let's go back to this example. You buy Apple stock on July 1st, and then you sell it on July 15th, and you net a loss of $1,000 on that trade because you held it through earnings, right? For example, okay? Now, you rebuy Apple on July 20th. You cannot deduct the $1,000 that you lost on Apple just earlier that month on this year's taxes. What's going to happen is that loss is going to get factored in to your new cost basis on your new purchase of Apple shares or Apple options. And so, for example, if like in a couple of months, let's say like November 15th, you sell Apple for a $200 or $2,000 gain, now your net gain is $1,000, right? Because you had taken that $1,000 loss earlier. You can't just write that off against your income. You now have a net $1,000 gain on Apple once you close out of Apple's position, let's say on November 15th. Or let's say you only make $500 on that second trade, still saying you lost $1,000 on the initial first trade back in July, but now you make $500. Now your net loss is $500. That is what you're going to be able to come to tax time and say, hey, I lost $500 on this trade on Apple stock, right? Even though it was technically 2 trades. You just can't sell it, take your loss, and then rebuy a few days later for tax reasons. That's where everyone talks about at the end of the year, tax loss harvesting. What we see sometimes is weaker assets or weaker stocks or weaker sectors will see some extra selling come the end of the year as maybe portfolios and people and traders are looking to investors to exit out of positions and then go into the new year and rebuy them, 2 months later, something along those lines. That certainly happens. And that's if someone's not necessarily day trade or very short-term trade focused. They're more so bigger picture focused. But again, like we talked about, not a huge deal if you're a day trader. Like, am I thinking about the wash sale rule when I'm trading my 5 stocks that I trade every single week? No, I'm going to trade this one. It's going to be a loss. Okay, move on. Let's try it again. If that same stock has a good setup 2 days later, I'm going to take it. Doesn't matter. That's how my mindset works, and that's how many traders' mindsets are going to work anyway. But it's something to note that when you're trading futures, this isn't even something you have to think about or worry about. The wash sale rule is not going to apply to you. So there you guys have it. Those right there are the biggest tax advantages when it comes to trading futures. If you didn't know, well, now you do. Make sure you go share this with a friend, and maybe you're considering switching over to futures. There's a ton of great futures products. There's the micro e-mini futures you can trade these days. There are a ton of ways to get into the futures game without having to take on excess risk that many people may think futures trading offers with some of the leverage that you've got access to. Let us know your thoughts in the comment section down below. Leave any questions. Happy to talk down there. Thumbs up on the video. Consider subscribing if you want more videos like this. Got tons of great playlists, got tons of great stuff here. And check out the sponsor of today's video in the video description box, Jigsaw Trading. Thanks so much, and we'll see you guys in the next one. Peace.